Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are talking about, go through the news. If there's any updates that I see that is financial related, it could be commodity related or wealth building related stuff. We're going to dive right into it. And again, if you want to follow me, it's at finding_finance, or you can check me out at finding-value.com. Join our membership there, join our community, and we do have a Sunday question and answer session at 5 p.m. Mountain Standard Time. So it says oil could blast off if it clears this descending triangle resistance zone, so far rejected at the resistance zone today. The one thing I will say is we've got positioning in XOP and OIH that has already broken higher. So I would expect this to potentially break higher here at some point. Cameco, CCJ, it says Cameco on a weekly basis so far. This is looking awesome. We have a breakout, we have a retest, and it looks like we can move higher. This month has been the second largest Treasury issuance in history, over 800 billion since the debt ceiling was extended. It is no surprise that the 10-year yield has been pressured higher. Only a matter of time before the yield curve control narrative becomes prominent again. COVID recession, US monthly Treasury issuances. You like how the COVID recession, how they basically dove us into a this gigantic recession by shutting everything down and then issuing a bunch of treasuries all at the same time at a very low interest rate. That's all going to have to be refinanced. Coming down, it says lower than expected jobless claims and the upward revision to Q1 GDP pulled up treasury yields. The Fed funds futures market is now pricing in a greater likelihood of 2 hikes this year. Well, I mean, that might have had something to do with it, or maybe how many treasuries they're issuing has something to do with it. See how this, so Tavi looks at it and says, look at how much they're issuing. This person's looking at data, first quarter GDP and expected jobless claims. And she's saying, look, this is where the rates are coming from. But behind the scenes, this is really where I think it's being driven. Boston real estate agent, buyers are waiving contingencies to even be considered. My recent listing had double-digit offers, all over asking. Still very little supply in Northeast and Midwest markets, which is pushing prices higher. Also, less competition from new construction. Whoa, whoa, whoa. I thought we were going into a housing bubble. How does this still exist all over the United States? Well, let's see. The demographic is larger than the supply of homes, and we don't have the inventory. DNN, what do you see here? Oh, is this a potential break? Well, we'll find out. We'll see if we get breaking on a lot of these different charts. CCJ is already on its way to the upside. I don't see why a lot of these smaller, more speculative companies couldn't be breaking out right behind it. We've got the 10-year yield. God save the queen, man. 4.5% 10-year inbound. Here we go, ready for a break. I do this on the daily technicals, big flag pattern, and we're breaking to the upside. XLRE, this is one of the most important overall charts, the real estate ETF. We're squeezing up here, and we could get a potential break to what I think is going to be the upside based off of all of the stuff I go over, the demographics, the market conditions, the inventory, all that stuff. It's going to break to the upside. QE Infinity says, Powell says at least 2 more rate hikes are coming. Bend over. Of course, rate hikes are coming. He's trying to slow down the demographic from buying more homes, which then releases more currency into the system from new homes, from new real estate stuff. It's all part of the cycle. XOP, yeah, you know me, oil and gas explorers. Breaking out here and looking good. Exactly. Here we go, breaking out. Remember, we saw crude oil that wasn't breaking out yet, but the XOP or explorers producers are starting to break out. Scrolling down here, it says, I know the macro bears don't want to hear it, but delinquency rates across all loan classes are still at or near all-time lows. Looks like the crash bros aren't getting what they want. I know a lot of people are really trying to extend their narratives. They're trying to paint a picture that they can't paint. Uh, it doesn't mean that we can't have a recession at some point. I just don't know if it is immediate as most of these crash people make it to be. And I know a lot of people, they listen to people on YouTube. You're obviously listening to me here. Be careful who you listen to, and be careful of the data and their interpretation of the data. I'm not in the recession camp that has to be immediate. A lot of people said, "Oh, we're gonna definitely pull back. Everything's going to crash because interest rates go up." That is not the necessary case. Um, Yield curves do not predict a recession. Yield curves occur before an recession. It doesn't predict anything. It's a function of the market conditions. It's a function of the cycle. It's a function of the demographic coming through. And yes, a recession can happen, but no one's going to know the exact timing of it. So be careful of all the predictors, especially when oil is ready to launch here. Oil fundamentals are about to turn decisively bullish. Rystad. We've got the Fed funds futures are now pushing out the first cut of May to 2024. Wait a minute. Crash bros, now we're out into 2024? What are we going to do? Just keep pushing it out? What about 2027? Maybe we get a slowdown before that, like the tech crash, and then we forge ahead after. That is a possibility. But I don't think people can predict it with the precision that they think they can. So just yesterday, it was anticipated as early as January, and even the markets are pushing this back and back and back. Now, this guy is saying we've got increasing interest rates here. It says bonds telling us recession, stocks tell us expansion. Who's right? He's wrong. Bonds are not telling us a recession. A recession comes when interest rates go down, not up. When they go up, that means you have a strong market economy, potentially, or you've got a crap bond market. Either one. When things go into trouble, people run to safety. And when they run to safety, they perceive treasury bonds to be safe. You'll see yields drop, not go up like this. This is either a problem in the bond market or people are afraid of inflation and they're getting out of bonds as fast as possible. It's not recession. It says, I always get a lot of responses to my no crash call on US housing prices that are variations on demographic decline charts. It's not that demographics don't matter. It's that by the time they will matter, prices will have doubled again. The boomers aren't all dying next year. I agree. The people who are interpreting the data are so jacked up that they can't even correctly identify or they can't correctly explain the data. So if people aren't being born immediately, I hate to tell them, but people who are 0 to 5 years old do not buy homes. It's people who are in their 30s. The average first-time home buyer is 36 years old. So they show you a chart. Look at the demographic. It's going down. And then I'm like, oh, really? It's going down for 5-year-olds. Retards. Sorry, guys. I'm not against retarded people. It's stupid people. All right? Stupid. So you have to look at the data that pertains to the demographic that can actually buy something. I don't know why they keep pointing to people who are 5 years old. I have a 5-year-old. I have two 5-year-olds. I have twin 5-year-olds. I hate to say it, but they don't have the money to buy a house. I don't even think they're thinking about buying a house. They're thinking about Roblox and Roblox bucks of how they can buy some car or something. That's probably what they're thinking about, or where they want to eat or something, which is like chicken nuggets. It says what regions in the world are the most vulnerable? Unfortunately, Europe and Asia will hit the energy cliff first, as they are the most dependent on oil and gas imports. Europe hit the first stage of the energy cliff in 2021. Economists totally ignore energy. I do agree with this. If there's an energy crisis, we're going to see the cracks where the people are importing the most amount of it. Because if there's a big tightness, then that's where all the fighting is going to occur for it. They're going to be bidding and trying to outbid each other for whatever energy they can get their hands on. Bob Elliott says, this is your weekly reminder that the U.S. labor market remains securely tight. Continuing claims falling, lowest in months and in line with sub 4% unemployment. Initial claims reversing much of the recent uptick. June jobs report will be good. Will be pretty good. No recession. No recession in his opinion. I'm just giving you guys data here that some of these guys are looking at. And I know there's others who look at completely different sets of data and come to conclusions that we're going to go into this gigantic recession cliff. Now, some of the data very well could be deteriorating. I agree with that. It doesn't mean that all of that data that they're looking at has any importance at all. There's a hierarchy of importance of data that we look at. One of the most important things to look at is housing starts. If housing starts continue to go up, I highly doubt that we are going to go into a recession. If you look at history and you look at the Fred housing starts, pull up Fred housing starts on Google, look at where all the recessions are at. There is not a single recession with housing starts going up. Not one. So what makes you think that this time will be different when we've got zero homes in inventory and a large demographic in home buying years that is about to run at the housing, that new homes, the housing starts? Then go look at all the new home builders. They're all making new all-time highs. So what data do they really have to cling on to? Some fictitious 5-year-olds that are declining in population growth that don't mean anything? What about all this other data they yank up? Oh, there's an increase in inventory of 75%. Oh my God. If you've got zero inventory and you go up 75% off zero, what is the overall increase? It's zero because it's nothing in inventory. You could have 1,000% increase in inventory and get you back to basically normal levels. Guys, the data that most of these people are sharing is just garbage, in my opinion at least. It says, and to think that many last year forecasted the economy to fall into recession. This is an economy that is much more resilient and agile than most others. First quarter economic growth was actually 2%, up from 1.3 first reported major GDP revision. You know why it's strong? Because the demographics coming through that is going to be buying crap. And a lot of people say millennials can't afford anything. I know many millionaires, multi-millionaire millennials, tons of them. I know a couple people that are just friends of a friend making $500,000, $600,000 a year. They own multiple multi-million-dollar homes that we're all millennials. I have guys that who retired in their 20s selling companies, and they are millennials. That was back, 10 plus years ago that they sold their companies for 30 or 40 million bucks. Not all of millennials, which is myself, are freaking broke. My brother isn't broke. All the people I work with aren't broke. We all own homes. Some own multiple homes. I would say we're all pretty much millionaires. So I don't know. I mean, the narrative that these people jump to, I think, is just, it's stupid. It's really stupid. It says 1-year yield is now higher than S&P 500 earnings yield. Hasn't been like this since late 2000. So that's a 1-year yield is now higher than the S&P 500 earnings yield. So yeah, maybe we are at the 2000 mark. Problem is, guys, it's this demographics that come in, and we could have stagflation. It very well could be. But in the 1970s, those recessions were mini booms in the housing market. We overbuilt, and then we crashed in the housing market. We don't have that right now. We're not going to crash in the housing market. We don't have enough inventory. It could take 2 or 3 years, even if we had a crash setup. It would take 2 years to build up enough inventory for us to really crash. It'd take, unless there's some sort of dark foreclosures that are going to come on the market. And I'm sure I'm going to get a bunch of people, oh, there's a bunch of dark foreclosures out there. We just don't see it in the data. It's like, oh my God, guys. Like, seriously, stop with trying to fill in a narrative to explain something away. The inventory is low. Just let it be. Let it be. I will say it again. Anyone who gets paid on a housing transaction basis is getting crushed. We are at 1996 activity levels. Now that is true. We have slowed down this market quite a bit. Nobody wants to sell, and I think a lot of people who are buyers don't want to buy because they're like, "Oh, wait till interest rates come back down." But what if they don't come back down? What if interest rates spike? What if they continue to spike? That is what it looks like is happening. But we'll see. Back in 2020, 2021, investors underestimate the impact, positive and negative, that the fiscal stimulus would have. The current $2 trillion in annualized fiscal deficits, of which $1 trillion is interest expense, is also a form of stimulus, just a less targeted type. That money's coming from somewhere, guys. They're just going to print it. That is stimulus. It's inflation. Is when rate hikes exacerbate inflation. The consensus is still that we can extrapolate the below trends, which brings this quote from Howard Marks to mind. Rule number 1, most things prove to be cyclical. Rule number 2, some of the greatest opportunities for gain and loss come when other people forget rule number 1. He's talking about the tech sector being incredibly expensive, or a large percentage of the proportion of S&P 500 versus the commodity sector, which is off the page cheap. This is all going to rotate. It's going to rotate like it did in the early 2000s, and it's going to rotate up, and this is going to rotate back down. That's our opinion that are commodity bulls, and that's why we're bullish on commodities, because we're taking the contrarian position. All the retail guys are over here. They're going to chase price, and price is going to dictate the narrative that everybody's thinking. When the price goes up, oh, tech stocks are going to do so good. It's going up. See? No one can take a contrarian position, it seems like, where you position yourself for success over a long time frame. Your time frame and that length of that time frame is your competitive advantage. Your advantage is to do opposite and to have a longer time frame and buy the cheap assets and wait for them to become overvalued. You can't do that if you're just chasing price all over the place. It doesn't work. You can't be in tech and make life-changing gains in a short period of time when the tech sector's, when everyone's piled into it already. That's going to rotate, and the market conditions are here for that to rotate, in my opinion. Tavi says, the bottom for gold is likely in. Here's a reminder that triple tops almost never work. The next step will likely be a steep upward move in price, blazing through its August 2020 highs and the Russian invasion peak. A new gold cycle is likely upon us, strongly supported by today's remarkable multitude of macro drivers. Time to focus on the big prize. First gold cycle, second, and then third. Get ready. What does that mean? That looks like higher interest rates, large fiscal deficits, and a large demographic creating credit by buying homes, which they're going to try to slow down, which is going to create a fiscal problem. Good. Crude inventories could go lower than last year's low next week. We're down here at no man's land. We've got Grady here, another one that he's got with Tavi. The inflationary 1970s caused a huge rise in gold. When called the commodities bear market low back in April 2020, also said we're in big inflation. I think this time is the next historical inflationary wave. Yes, it's clearly wild chart, but not impossible. Wave 1, and here we go. You don't have to agree, but the big picture remains extremely bullish for silver. Exciting times ahead for silver, ready for a big breakout here. All these charts are all basically interconnected. They're all pointing to certain things. That's what it is. And here's Scott. He says, yes, it seems like it's taking time, but nothing wrong with this chart. Grinding quite beautifully above the 200-day weekly moving average. Hey guys, I'm going to end there. Everybody give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. Join our community. You can use the word discount in the coupon code. We've got a 5 p.m. Mountain Standard Time question and answer session on Sunday. Love to see you there. Hopefully everybody's having a good day in the market. And that's all I've got. This is Finding Value.